Original Medicare handles a lot, but Parts A and B leave significant financial gaps behind, and you must decide how to fill them. When people compare their options, they usually evaluate the wrong metrics. They focus on the monthly premium, or whether the plan includes a free gym membership. Your first option is Medicare Advantage. This path optimizes for a low or even zero monthly premium on day one, but you pay for that low upfront cost on the back end. You live inside a restrictive network of approved doctors and hospitals. You often need the insurance company's pre-authorization before you can get care, and your costs are variable. You pay as you go until you hit a large out-of-pocket maximum. Your other option is Medigap. This is built for zero friction at the doctor's office. You can use any doctor or hospital in the country that accepts Medicare, with no networks and no pre-authorization delays. This chart maps the core trade-off you must make. On the bottom left is Medicare Advantage, low monthly premium cost, but low predictability and restricted freedom. Medigap sits on the exact opposite end. You pay a higher premium, but secure maximum predictability and total freedom. Lifetime access and total out-of-pocket exposure define the true cost of coverage, outweighing the impact of any day-one monthly premium. Every Medigap policy is strictly standardized by the government. The core benefits of a Plan G are exactly the same no matter where you buy it or who you buy it from. Yet, if you cross a single state line, the exact same standardized plan can literally double in price. That massive price swing comes down to three variables: the specific pricing rules allowed by your state, the level of competition among local insurance carriers, and the aggregate health of the regional population. In a highly regulated state, your monthly rate might be twice the national average. Drive next door to a state where carriers compete fiercely, and you'll find some of the lowest rates in the country. Deciding you want Medigap is only the first step. To avoid overpaying, you have to understand the hidden pricing laws specific to your zip code. Every state dictates how insurers can set their rates using what are called pricing methodologies. These rules decide what you pay today and how fast your bill climbs over the next 20 years. The most common method is attained age pricing. Under this rule, your premium is based on the exact age you are today. This graph illustrates how attained age pricing behaves over 20 years. The curve starts off very low on the left. That cheap day-one entry point is exactly what makes it so attractive to buyers. But because it's tied to your attained age, your rate automatically ticks up every single year on your birthday. That cheap starting rate eventually compounds over time, making it the most expensive option on the board. Now, look at this second line. This represents issue age pricing. Your rate anchors to the exact age you were when you purchased the policy. It starts slightly higher, but the curve remains remarkably stable. The primary benefit here is certainty. With an issue age policy, your baseline rate will never increase simply because you had another birthday. The trade-off is timing. You pay slightly more upfront, and if you delay purchasing until you are older, you penalize yourself by locking in a much higher permanent baseline. Optimizing purely for the lowest starting price on day one often guarantees you pay the highest total cost over your lifetime. There is a third method, mandated by a specific group of states, called community-rated pricing. Under this rule, age is legally removed from the pricing formula. Everyone in the community pays the exact same rate for the same plan. If you are an older buyer, this is a massive financial advantage. You pay the exact same premium as someone decades younger than you. The downside falls on the healthy 65-year-old. You heavily overpay upon entry to subsidize the older, more expensive policyholders in your pool. This map shows how these pricing rules are distributed across the country. You cannot choose your methodology. It is entirely dictated by which of these regulatory environments your state falls into. A community-rated state like New York guarantees extreme rate stability, but demands very high premiums. Right next door, a competitive attained age state offers fierce price competition today, but guarantees future volatility. Your zip code decides whether you are buying long-term financial stability or a creeping financial liability. One of the most confusing things about Medigap is that you can go years without visiting the doctor or filing a single claim and still get hit with a rate increase. It's not a mistake. When you buy a policy, you don't just buy individual coverage. You join a block of business. This is a localized pool of thousands of people who bought around the same time you did. Your personal health has zero impact on your rate hikes. Those increases are driven entirely by the aggregate health and the total claims filed by the entire block. And the insurance company is heavily regulated here. They must mathematically prove aggregate block losses to your state commissioner before any group rate hike is legally approved. Every Medigap policy anchors your financial liability to the collective health and stability of your localized group. With all of that in mind, let's look at a diagnostic framework to help you route yourself to the correct Medicare choice based on your budget, your geography, and your risk tolerance. Take a look at this flowchart. The first critical threshold is straightforward. Can your monthly budget comfortably absorb a fixed premium of $150 to $300 without strain? If no, you route directly to Medicare Advantage. If cash flow is tight, Medicare Advantage is the appropriate choice. You must meticulously manage in-network providers and plan for your out-of-pocket maximums. If you have budget flexibility, prioritizing peace of mind and no networks, you move down to the second question. Does your state mandate community rating? If you live in a community-rated state, you have to budget for high day-one costs, but you gain the immense benefit of extreme, long-term rate stability. If multiple pricing methods are allowed, prioritize your ultimate financial goal. Prioritizing day-one savings routes to attained age. Prioritizing a flat lifetime cost routes to issue age. Choosing attained age means you must actively plan for a compounding annual increase. Choosing issue age requires buying in as early as possible to lock down your baseline. Medigap functions as a localized financial instrument, where evaluating the long game buys a predictable future.